If you recall, I mentioned that Thursday can end up becoming the weekly high. I stated that Thursday tends to make the opposite end of the range. So if it's been bullish, as it's been here, it's been going up since Monday, and then we get to Thursday, and Thursday caps the weekly range on the upside, and then Friday we see it trade down. It comes off of the low on Friday, but it's still not going higher than Thursday's high. Now, some of you are thinking, wow, that's kind of neat. Like, that's something he did talk about, and it's right here in front of me. Well, we're going to go one step further, because for some of you hardline critics in here, I'm going to blow your socks off. If we zoom in, drop down into a 15-minute time frame, I also told you the time of the day on Thursday that the weekly high in bullish environments tends to form. That is New York Open. The question is this: what do you do with that information? Well, there's several things you can do. Number one, if you are a short-term trader, you want to have the bulk of your trade off as you're going into Thursday New York Open. If you've been long or been scalping and you've been bullish all week, you really want to try to avoid taking any new long positions after Thursday New York Open. And the bulk of your positions should be squared and leaving only a small portion on in case Friday runs a little bit further in the upside. But you're going to find that about 70% of the time, why 70%? Go back through the data like I did for 40 years. That's what I did. And it comes to around a 70% likelihood that this is what happens. Now, for some of you that heard me say that, you're going to say, every single week, ICT says 70% of the time, Thursday makes the high of the week. That's not what I said. There's filters that were applied to that data crunching. When the market is bullish, Thursday, New York Open tends to create the high of the week 70% of the time. What happens when the market's consolidating majority of the week? Is it likely to create the high of the week on Thursday? No. That's not what I said. When you are one-sided and it's been delivering buy side predominantly, in other words, it's just been a bullish day, Monday, Tuesday, Wednesday, going into Thursday. Or if you looked at the weekly range from where it opened on Sunday to where it is trading on Thursday at New York Open, if it's been up in a bullish range, then it's probably creating the high of the day then, between 7 o'clock in the morning and 9 o'clock in the morning, New York local time. So if we look at this high on Thursday at New York Open, what did I teach you about the wicks and the tails of candles? The wicks and the tails are usually the variance by broker. You can't lean heavily on the wicks and the tails when you're looking for entries. Now, when you're measuring ranges, when you're trying to get the total range from low to high, you want to incorporate the tails and the wicks. But for entry purposes and targets for actual trades, I focus on the bodies. Okay, so with that logic in mind, looking at this area right in here, we had relative equal highs in here. So we had buy side liquidity here. The market runs up and takes that there. You see that? It runs above these highs right there. When did that move start? Did it start here? No. Did it start here? No. It started right there. Why here? Well, look at all the run up here. It dropped down. That's just a retracement taking stops. Runs again, comes back down, reaccumulates at the order block, and then pumps it through to get the buy side liquidity. So look at all this congestion in here, all that consolidation right there. Did this go below here? No. So we have a low, and then we have another low here, but it doesn't violate this dealing range low. So it's inside of that range, but it starts to run to here from that level. So that's why I'm telling you this is the dealing range low. So if you're looking at price, you're focusing primarily on these particular levels. The highest up close, the lowest down close. Now, in certain instances, you'll see that inside this area, it might be the lowest opening price. It's the lowest body, okay? So a body is defined by the open or the close. So we're looking at the lowest of either the open or the close, and we're looking for the highest of either the highest close or the highest opening price. So with that in mind, I'm going to add the Fibonacci on there. Now this time, I'm taking off that 0.2 and 0.3 level, and I'm only wanting to show the 0 level, the 1 level, and the -1 level. Now what that's showing here is a measurement from this candle's highest body to lowest candle body here. And it projects that range down 1 deviation. So the standard deviation of 1 of this range. So all we're doing is getting a measured move from this candle's close and this candle's close, and that same range projected from this candle's close down. That's what the math is doing with this indicator. All it's doing is allowing me to show, without having to draw it out, this is the level that's projected as a downside objective, which notice also is below. This is that 30 level, and this is that 20 level. In other words, this is 0.2 on that fib and 0.3 on that fib. When we drew it from the daily chart and all those levels were removed and only the 0.2 and 0.3 level was still in the fib, that's what these levels are here. When we drop down from this high at Thursday New York Open, we sell off and we go over the 0.3 level, or which would be 30% of the range that I measured from that daily order block up to this high. So did I pick out the high randomly? Is it hindsight? No. I told you Thursday New York Open tends to create 70% of the time the opposite end of the weekly range. Well, here's Thursday, here's New York Open, there's the high forming, and we're trading down here. What if you're not satisfied with just being able to call it down 30% of a retracement inside that range? What if you want to get really, really good at calling specific levels? Well, you have to incorporate the market structure here. Now, this is institutional market structure. So when you're looking at market structure, you want to know how far a range can go. You have to have all the things I just gave you here, which were framed on institutional logic. Thursday New York Open tends to create the high of the week in bullish market environments. When does it not happen? When you have a real excited high impact news event on Friday. If there's a lack of any kind of news on Friday, generally that you're going to have that Thursday influence that you see here. Now, what I marked up over here was the institutional logic with this dealing range here. So I use this low that leads to this high here. So that is your dealing range that you work with for projecting downside standard deviations of 1. So this was 1 standard deviation going up to take the buy side liquidity out over here, but also forming the weekly high. Now we're going to take a huge quantum leap forward. If this is the high of the week and we take out this low, how far can we go down? Well, we can go down to 20% of the weekly range. We can go down to 30% of the weekly range, but in case we get a little animated, where's it going? 1 standard deviation here calls for 1.20817. Now, mind you, this is Forex.com's data feed. So your live account, the low here is going to be slightly different because, again, as I taught with the wicks and the tails and the candles, your broker's allowed to have a little bit of fluff in there, and sometimes they won't give you the low. Sometimes it'll go a little bit lower than what I'm showing you in TradingView. That's okay. If you use 30 as your ideal, but standard deviation is just below it by a little bit, stick to the 30, and that'll be enough, okay, plus spread. But what about this over here? If we extend that out in time from that level, boom. Now think, high of the week, intraday, retracement carried over into Friday. Where's it going to go to? Right here. If you look at the Monday's low, Monday creates the low of the week. Thursday's New York Open creates the high of the week. When I tell you I can call the low and the high of the week, a lot of it has to do with what I'm showing you here. Not everything, not every instance of it. There's other things I'm going to teach you as we go through this year that leads to these types of results. But if you had one-sidedness like this all week, from Monday up into Thursday, chances are, unless there's a Friday high impact, medium impact is not so much a factor, but usually a high impact. news event, and it's not likely that Friday has these high impact red announcements on the calendar. But if there's an absence of that high impact on Friday, you have the likelihood of Thursday creating the high of the week. Now, you don't always get an instance where it trades down this far. Sometimes it'll go just to 20% of the weekly range. If that's enough for you to find a trade in as a counter trend trade, that's something you can obviously explore and see if that fits inside of a model that you would feel comfortable trading with. It's very fascinating if you ever decide to trade it, that's one thing. But if you don't want to trade it, the study of it and how often it forms is really interesting. If you consider what I've shown you here, with this chart here, if we were looking at it from the scope of a weekly range, and we were looking at an open, high, low, close bar of the weekly range, it would look like this: the high and the low of the week, and where it opened for the week and where it closed. Again, we're not trying to forecast the closing price. But if you look at that weekly range, what I'm trying to impress upon you is, as a short-term trader, my focus is, if I'm bullish, I'm going to look at that opening price on Sunday. That's here. If I'm bullish, I'm going to be working most of my attention in the area right down in here, because that's usually going to be the first thought process is Monday low of the week. If nothing really lines up with technicals for me to suggest that Monday's creating the low of the week, then I'll look for Tuesday, because Tuesday generally is 70% of the time the low of the week. That's usually in London Open. Not all the time, but 70% of the time, when it's going to be a bullish week, that's usually what takes place. If it starts and creates a low on Monday and rallies up, and the London Open on Tuesday doesn't trade lower than Monday's low, then you have to obviously consider the fact that the low of the week was Monday, and therefore anything past London Open on Tuesday, just focus on being a buyer and don't anticipate Monday's low being taken out. There are some things you'll learn to anticipate Monday's low being taken out, but predominantly what I just said is true. Thursday is the high of the week when you're bullish, as I indicated in this here. But what changes that or negates that likely unfolding is, again, the economic calendar on Friday with a high impact news event. If it doesn't have one, chances are 70% likelihood Thursday is going to be the high of the week in New York Open. If you're going to be a counter trend trader, I'm not interested in selling short in weeks like this unless we get in this area here, and then I can take a counter trend short and sell short. That's the highest probability area to sell short when this criteria is in the marketplace. Otherwise, if you look at what's been going on in your losing trades, you fell victim to trying to sell short in all of this between Monday and Thursday. Somewhere in here, you're trying to sell short. That's how I lost. That's how I blew accounts too. Now you know the secret to why you're losing money. Now that you understand it, you can at least hopefully stop losing money and growing towards break even. Spend some time at break even, and then you'll be able to use information like this lesson here tonight to work towards profitability.